shares of Carvana are ripping higher, up about 17% this morning after the used car retailer got an upgrade from underweight to neutral over at JPMorgan, saying investors have digested the risks around the stock. Carvana has become one of the most hated stocks on Wall Street. Wall Street hates this stock. And so it is surprising to see this upgrade. I think the overall gist of JPMorgan here is that Carvana may not need to raise capital in the near term, and that is triggering their upgrade.
Yeah, look at this stock performance year to date, now down 93%. And, even as we're continuing to watch how investors are evaluating Carvana, this does come back to the same conversation we were having with AutoNation a moment ago about what the depreciation of some of the inventory looks like, getting inventory that they're actually going to be able to sell through as well, and at what price consumers are actually going to take price and kind of move some of those vehicles off the lot, especially at a time where there's a shift in the sentiment, or at least in going towards some of the more electrified models. And we've seen that show up early in Carvana's numbers earlier this year. CarMax has reported on the success that they've seen with regard to some of their EV sales, even as you're starting to see the early churn in adoption there, or a churn that is moving more of those vehicles into a Carvana landscape at least.
Want to make a bad financial decision? Buy a used Tesla with 60,000 miles on it from Carvana. I mean, that just has all the makings of a potential battery, just not going well.